Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
Today, we are dissecting what is probably one of the most anomalous stocks on the over-the-counter market, Zion Oil and Gas, ticker ZNOG. This is a case study that, well, it completely transcends typical financial analysis. It operates at this really volatile intersection of microcap energy, extreme Levantine geopolitics, and a very deep, very committed evangelical theology. It's a puzzle where the normal rules of valuation just don't seem to apply.
Indeed, and it's the recent price action that makes this puzzle so urgent. As we're talking now, in December 2025, ZNOG is trading pretty persistently between 18 and 20 cents. Now, that might not sound like a lot, but based on their fully diluted share count, you're looking at an enterprise valuation of about $211 million. And crucially, that recent move, that spike from around 16 cents up to that 20-cent range, it came on significant volume expansion. It allowed the stock to, technically breach its 50-day moving average.
Right. And that breach, that volatility, that leads us straight to our central question here. Is this sustained, seemingly non-fundamental valuation, and especially this recent surge, is it primarily driven by definable market microstructure and some highly coordinated promotional campaigns? I believe the evidence points overwhelmingly to these structural and technical mechanisms that are designed to exploit this retail base.
I come at it from a different angle. While I do accept that market structure and promotions can explain short-term spikes, the liquidity events you're talking about, they just can't explain the decades-long survival of this company. That enduring nine-figure valuation is, I think, inextricably tied to a singular phenomenon, the theological investment thesis. That thesis creates a very measurable, very resilient faith floor that stops the price from ever collapsing to its operational reality.
Okay, so let's start right there with the volatility in December. We agree the move from 16 to 20 cents wasn't fundamentally driven. I mean, the critical MJ01 well is still shut in. Instead, that jump was the direct result of a highly coordinated external marketing push. We saw clear evidence, newsletters, specifically Porter & Company, and algorithmic alerts from places like MarketBeat. They were the initial catalysts. And this influx of promotional liquidity was just enough to trigger secondary, algorithmic momentum buying once the stock cleared that crucial 50-day moving average. It's a classic technical move in an information vacuum.
I absolutely see the efficacy of those campaigns in driving momentum. But the market mechanism that's always surrounding ZNOG is where the retail anxiety really flares up. I'm talking about dark pools. How does your technical analysis account for the perception that this stock is just being constantly suppressed by institutions?
That's an essential point, and it lets us demystify one of the biggest misconceptions in microcap trading. We constantly see these high readings for what's called off-exchange short volume. Sometimes it peaks like it did at 58.73% on December 4th. Now, retail investors see that and think it's clandestine institutional shorting trying to crush the price. That is incorrect. It's actually a structural artifact of wholesale market making. When you have individual retail investors aggressively flooding the market with buy orders, which is what happens during these promotions, the major market makers, firms like Citadel Securities, they internalize that flow. This means they're buying from the seller and instantly selling to the buyer. And to provide that immediate liquidity, they technically sell short for a moment.
So they're essentially acting as the intermediary, selling to the buyer before they've even acquired the shares from the seller.
Exactly. They are providing instant execution. Then they flatten their books, meaning they go right out and acquire the shares to cover those shorts, and they lock in a tiny spread. So the high off-exchange short volume ratio is, paradoxically, a sign of intense, persistent retail buying, not institutional suppression. It just confirms the flow is retail-driven and entirely technical. It's the structure of liquidity provision reacting to demand.
That's a very sophisticated explanation of microstructure. But if we pull back from the flow dynamics, your technical analysis fails the ultimate test. It can't explain why this company has survived for 25 years with a nine-figure valuation without ever achieving sustained commercial hydrocarbon production. I mean, any other microcap energy venture with 2.5 decades of dry holes and Operational failures would be a defunct entity. It would be trading at fractions of a penny. So why isn't this one?
And why do you believe the structural drivers don't account for that long-term resilience?
Because the bedrock of the company is this unique faith floor. The core shareholder base, they approach investment through a literalist interpretation of biblical scripture. The company explicitly references passages like Deuteronomy 33:24, the prophecy that the tribe of Asher will dip his foot in oil, as justification for their whole mission. For these shareholders, operational failures, drilling disappointments, they aren't reasons for capitulation. They're interpreted as tests of faith. This spiritual commitment creates a shareholder cohort that is largely price and time insensitive. They hold on through decades of dilution where any traditional investor would have liquidated years ago.
Mm-hmm. But that faith base is only effective because of the structural mechanisms management uses to continuously extract capital from them.
Precisely. Let's look at the capital structure. While ZNOG management skillfully avoided the devastating optics of a reverse stock split, like when they moved to the OTCQX in 2020, their continuous unit programs function as a sort of synthetic dilution mechanism. They sell a unit, which is typically one share of common stock plus a warrant.
And for the audience, a warrant is basically an option to buy more stock later at a predetermined price, which in ZNOG's case is usually around 25 cents.
Correct. And this continuous stream of warrants, exercible just above the current trading price, creates a perpetual supply overhang. It's a structural technical ceiling that inherently caps any sustained rally. Management is essentially selling future stock supply today, and they're using the faith-basis commitment as the fuels to keep the company funded. It's financial engineering built on top of spiritual conviction.
Right, and now we have to confront that operational vacuum again, because that's where the technical narrative really takes hold.
But structure aside, what about the brutal reality on the ground? I mean, how do you account for price resilience when the operational facts are catastrophic? The MJ-01 well is still shut in and suspended. This decision came right after the crews had to be completely demobilized, reportedly just hours before the 12-day war with Iran started in mid-2025.
And we can't dismiss the geopolitical risks. They're existential. We have verifiable reports of extreme security concerns, even mentions of agricultural terrorism in the Megiddo-Jezreel Valley. By any traditional valuation model, this level of operational risk, coupled with the shut-in well, should have driven the equity value towards zero.
And that is the foundational arguments for the primacy of the faith base. Only a shareholder cohort that views this as a spiritual mission, not a financial calculation, can absorb that level of risk and maintain their holding. They aren't trading volatility. They are holding for a miracle. They are fundamentally price insensitive to negative operational news.
I see why you emphasize that point, but I'd propose a different mechanism. The operational vacuum enables the promotion and the technical trading. The critical distinction is the lack of negative operational news. The only material report they put out in 2025 was the initial gas-to-surface event in May, which was, a milestone, but definitively non-commercial. Since the war, the well has been shut in. So for narrative traders and for the algorithms reacting to momentum, no bad news is functionally the same as good news. The stock is trading purely on promotion, technicals, and hope because there are no immediate fundamentals to contradict the narrative.
But if it's trading purely on momentum and promotional pumps, as you claim, then the risk of a massive short squeeze should be constant, shouldn't it? Similar to other retail-driven stocks.
I'm glad we're tackling the squeeze fantasy, because mathematically, the thesis is impossible. You have to look at the true institutional short interest, the overnight settled positions. It is negligible. It's holding at about 207,000 shares, which is only 0.02% of the float. There are simply no institutional shorts to squeeze. And this proves that the price action is driven entirely by the demand side, by long-side retail momentum reacting to the promotional activity. The technicals are the operative factors that drive the volatility, regardless of the faith that supplies the initial capital.
Okay, let's follow that. You stated that the perpetual warrants from the unit programs form a technical ceiling around 25 cents.
Well, I wouldn't say that's the full story. I'd frame it as a strategy of control. The existence of those warrants is the ultimate technical ceiling, yes. But what it reveals is management's mastery of market structure. They are structurally exploiting the faith-based raising capital continuously, while simultaneously ensuring the stock cannot break out long-term beyond that 25-cent barrier.
And why is maintaining that ceiling structurally beneficial for management?
Because by consistently limiting the stock's volatility, they limit the downside risk for any sophisticated short seller who might consider getting involved. This structure keeps the stock in a narrow, predictable, exploitable range, ensuring continuous capital infusion without the high-risk volatility that attracts real institutional bears. It's structural control enabling continuous fundraising.
I find that view compelling from a cynical perspective, but it ignores the segmentation of the shareholder base. We have to remember this stock is structurally excluded from the Wall Street Bets meme ecosystem. It's OTC, it doesn't have options liquidity, the volume is relatively low. So the base is not the speculative degen cohort that chases gamma squeezes based on charts alone. The base is the geology-confirming theology echo chamber.
Why does that segmentation matter so much if the price action is still determined by volume and momentum?
It matters because the ability of the company to continually raise capital via those unit programs relies entirely on the unique persistence and price insensitivity of that faith-based investor. That investor isn't viewing the 25-cent warrant price as a cynical technical ceiling. They're viewing it as participation in a spiritual mission. The underlying sentiment, the religious conviction, is the primary fuel source that allows the technical structure, the warrants, and the dilution to even exist. Without that conviction, the company would have dissolved and the technical mechanisms would be completely irrelevant. The belief dictates the capital structure.
So you view the technical mechanisms, the warrant dilution, the promotional spikes, the 50-day MA breach, as just scaffolding that rests on the bedrock of theological commitment. The scaffolding explains the movement, but the bedrock explains the existence.
That is a perfect analogy. The scaffolding explains the volatility and the recent liquidity event, but the bedrock, that unique, enduring commitment, explains the valuation anomaly and the 2.5 decades of defiance against financial gravity.
So to summarize my position, the recent trading activity, particularly that sudden volume expansion and the price rise to the 18 to 20 cent range, is primarily a function of targeted promotional activity and the predictable technical response to breaching the 50-day moving average. The stock is trading on pure technical momentum and narrative manipulation, thriving in the vacuum created by operational silence. The price movement is a liquidity pump, pure and simple.
And to summarize my stance, while I acknowledge the critical role technical factors play in short-term liquidity events like the December spike, the stock's multi-decade resilience and that persistent $211 million valuation are anchored by the unique shareholder thesis. This cohort interprets financial and operational risks through a theological lens. This faith floor effectively neutralizes the severe downside pressure that catastrophic operational facts and continuous synthetic dilution should normally create in a rational market. The market structure in this case is simply parasitic upon the underlying durable sentiment.
ZNOG presents a profoundly challenging anomaly to anyone who believes valuation must be tied to traditional metrics like reserves or cash flow. It illustrates how specific shareholder cohorts can completely break standard financial models.
It serves less as a conventional energy investment and more as a sophisticated study of the human elements of faith, conviction, and targeted marketing that govern these very specific, highly resilient segments of the microcap market. The evidence really provides ample support for both of our conclusions.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.